Hey everyone, and welcome back to Markets in 2 Minutes. This is Darrell from the Wealthspire Investment Team. There's a lot to discuss this month, and it's likely this is going to be a little bit of an extended version of the series, so I'm just going to get right into it. As you've likely seen, the Trump administration surprised markets earlier this month with an aggressive implementation of tariffs that went well beyond what most market participants were expecting. And that led to a flurry of volatility as markets sort of grappled with the new messaging. It's now clear that we are entering a different type of policy environment, and the period of low trade barriers from World War II until today is now essentially over. Some of what was discussed initially has already been walked back, but it is likely that the effective tariff rates will land somewhere in that red shaded region of this chart, which represents a substantial shift and one that markets have had a hard time digesting. And you can see here that markets were actually trending higher to begin the year, but have since given back all of those gains and more as the tariff uncertainty sort of took hold. There hasn't really been anywhere to hide in equity markets, though some areas have performed better than others, with international equities actually having protected quite a bit better to the downside, partly as a result of currency dynamics. But even accounting for that, the resiliency overseas has been quite noteworthy and has really been driven by a broader rotation out of US assets. But the natural question sort of becomes, where do we go from here? And the answer to that question is very much up in the air right now. But here's a thought exercise designed to highlight the different potential catalysts going forward, starting with the potentially positive developments. The first is that the Fed cuts rates and relieves some pressure on the economy. Now, that doesn't appear super likely, just given Chair Powell's recent comments and the Fed's need to balance all of this uncertainty against a backdrop that is decidedly inflationary. But looking out to further meetings, if the unemployment rate ticks higher, that does give them some freedom to move, and that could potentially give them the opportunity to relieve some pressure. Another positive development would be tax cuts. Everyone has been so focused on the tariff situation that many have begun to overlook the possibility that the administration plans to implement another round of tax reform later in the year, which would help to offset some of the negative economic impacts of tariffs. And then you also have this idea that after one domino falls, it accelerates the timeline to getting other deals done because countries don't want to become comparatively disadvantaged. So, for example, if India decides to negotiate, then that could prompt a country like Vietnam to move more quickly as well, and that would move the timeline up for getting some of that tariff policy walked back. And then lastly, there is a mechanism for Congress to put some pressure on the president as well by threatening to block his tax bill later in the year if he doesn't walk back the aggressiveness of some of these policies. And there's a thin majority for the Republicans, and so it would only take a few moderate defectors to put the passage of tax reform in jeopardy. And that could change dynamics in Washington and cause the president to potentially change his tune. Now, on the flip side, the obvious catalyst for further pain in the markets is retaliatory tariffs. We've seen this already with China, but if other countries respond similarly, then that would escalate the market's concerns and effectively further isolate the United States and accelerate the decoupling of global trade that the market's most worried about. There's also the risk that these policies simply don't work as intended, but the administration remains steadfast anyway and commits to sort of push past the point of no return, and that more meaningfully impacts the US economy. And then there's this third concept, which is just a mapping out of how this policy initiative could push the economy potentially into recession, right? You get a freeze on investments because businesses don't have any clarity. They cut back on hiring, and then you get an increase in unemployment, and you start that downward cycle, which more significantly weakens growth. And then this last one here is the longer term concern, which is that foreign investors continue to pull capital from US markets and pick away at some of the luxuries that the United States has been afforded for so many decades as the best place to do business. The bottom line, though, is that this is a very fluid situation, and there really isn't much that we know definitively right now. And that's part of why markets have been so jittery. As far as strategy goes, we continue to focus on the long term and are encouraging others to do the same. The risks of making an investment mistake in a market like this is incredibly high. And so, in our view, the best thing investors can do is accept that volatility is part of the price of admission and ride things out until we get more clarity. It's something we're watching very closely, and we'll circle back next month with another update. Thanks for tuning in.